If you're in the market to buy a home right now, there's finally some good news because home prices have finally started to fall in some pockets around the country. This is where some people are getting ready to finally go and buy their dream home on sale, hopefully, but some experts are saying, hold on just a minute. Christopher Mayer, who is the co-director at the Paul Milstein Center for Real Estate, says that, quote, from an affordability perspective, this might be the worst time you could buy because mortgage rates have spiked quite a bit. In other words, the higher interest rates are making home affordability drop even lower, which means that sellers are going to be forced to cut their prices if they want to be able to sell their home, which could create a discount opportunity for you because now if you want to buy a home, not only is it very expensive, but your mortgage is also very expensive. For the last 12 to 18 months, when home prices went up, it wasn't as big of a deal because you could get a mortgage for very cheap. In many instances, you could get a 30-year fixed rate mortgage for under 3% a year. Well, now home prices are higher than they were before and mortgage rates have doubled from where they were before. So not only do you have to borrow more dollars, but you have to pay more interest to borrow those dollars. And what he's saying is that this is a recipe for home prices to come down. So if you're thinking about buying a home, just wait. Now I will give you my thoughts towards the end of this video, but let's talk about what this means actually. We've already seen home sales slow down at some of the fastest rates that we have seen in a very long time, but it's not just home buyers who are now turning away from the housing market. It's also investors. Investors purchased 19.4% of homes sold in the second quarter of 2022, which is lower than the 20.1% of homes in the first quarter. This means one of two things. Either investors are buying less homes or home buyers are buying more homes. Well, we already know that home buyers aren't buying as many homes now as they were before. Home buyers are buying less homes, while investors are also buying less homes. So we're seeing home buyers buy less homes, we're seeing investors buy less homes, but we're seeing investors buy even less homes than before than homeowners. The worry that a lot of people have right now in the housing market is not foreclosures, because there's still a lot of equity that people have in their homes. So if you lose your job, you can't make your mortgage, you still have equity so people can sell or refinance and walk away from the home without having to worry about being foreclosed on. So right now, foreclosures are not an issue. The bigger issue that people are worried about is what happens if institutions who own such a big chunk of homes nowadays decide that they want to get out, that maybe home prices didn't grow as fast as they would have liked, they don't like which direction the housing market is going, and they want to liquidate, and they start to sell. Well, let me show you what Christopher Mayer said. I do think some of those institutional buyers are going to face challenges in the market trying to get rid of them, but I don't think it's going to make it a buyer's market. The interesting thing here about the big institutions that have been buying real estate is, unlike somebody who goes to buy a home for themselves and now the bank is going to appraise the home and give you a loan based off of the home, a lot of these institutions have been getting appraisals based off of not the homes, but based off of their other investment portfolio. So if you have a huge multi-billion-dollar stock market portfolio, you might go to the bank and say, hey bank, give me $1 billion based off of my multi-billion-dollar investment portfolio. And now you take this $1 billion that you have and go out and buy real estate because it's easier to do that. Well, what happens now if the market starts to go down? Not in the housing market, but in the stock market and other company valuations. And now you start to see the value of your other investments go down. And now at the same time, you're starting to see real estate go down. Well, you could be forced to sell some of your assets to make up for this investment loan that you have, not the real estate loan, but this investment loan, because the value of your investments have gone down, because we're seeing valuations go down. And this could force some institutions to want to sell their homes quickly. Now, again, it depends on how many institutions there are, how many institutions are forced to sell, and if that does happen, that could force a lot more liquidity into the markets because right now we don't really have that much liquidity. Yes, people aren't buying homes as fast as they were before. Yes, the amount of days that a home is sitting on market is growing, and yes, we are starting to see the prices of some homes in some areas start to fall, but there is still a lack of inventory out there. And so we're facing this issue where there's still a lot more demand than supply. The amount of demand is starting to fall, but there's still not that much supply out there. So if we were to see any sort of supply shock, that could really flip the market because now you have a whole lot more homes hitting the market with not that many people out there that want to buy them. So this is where you want to pay attention to the demand and the supply, especially when it comes to the housing market. Now we're covering all of this in Market Briefs. If you haven't subscribed yet, it is my free financial newsletter where every day my team is breaking down what's happening in things like the housing market and stock market and crypto and inflation and the global economy. It's completely free. It's a free newsletter. All you got to do is subscribe, and then every day in the mornings my team will email you what's happening in the markets. You could read the email in less than 5 minutes every morning, and I promise you are going to look forward to reading Market Briefs every morning. So if you want to join Market Briefs for free, I'll put the link to how you can do it down in the description below. This is where now you're probably wondering, what does this mean for me? If I want to buy a home, should I wait to buy a home? Should I go and rush to buy it now? Should I sell my home? Look, if we are talking about the home that you live in, the home where you want to create memories, the home where you want to raise a family, you don't want to be trying to time the market. Sure, if the Federal Reserve Bank continues to raise interest rates, home prices will fall. Correct. But if the Federal Reserve Bank decides to cut interest rates in 6 months or 12 months or 18 months or 24 months, that would also cause home prices to rise. It's very difficult to start trying to time the market in the housing market, especially when you're buying the home, not for the purposes of making money, but for the purposes of making memories. And so this is where you have to understand what your goal is. If you want to buy a home to make memories, to live in, to raise a family, don't try to time the market. Buy a home that you can afford, that you love, that you want to spend time in, and when you can afford it, go out and buy it. And then you might say, but Jaspreet, what happens if home prices fall by 50% in 2 years? Well, if you still have a job because you have an income, because you bought a home that you can afford, and you have a fixed rate mortgage, it's not really going to affect you because the equity is really just invisible money. You can keep making your payments like normal, and then you can just ride it out. I'd much rather you spend the time, effort, and energy and research trying to analyze an investment property, trying to find a good rental property that will actually make you money, because now you're buying this property for the purposes of making money, not for the purposes of making memories. It's a very different analysis. And now if you're talking about something to buy as an investment, this is where you want to be putting in the time, effort, and research to find an undervalued property. If you're trying to buy something that you love, that you like, who cares if you're paying a premium for it if it's something that you want? You just have to make sure that you can afford it first. And this is where you have to understand that owning a home is a luxury. Yes. Does that mean you have to do it? No. But if you want to be able to do it, you should be able to do it and afford it. That way you can do it the right way. And just understand that, because now if you're going to go out and buy a t-shirt, you're not going to be looking at the markets and saying, ooh, I think the price of t-shirts are going to fall in 6 months or 12 months, so let me wait to buy my t-shirt. No, you're going to find a t-shirt you like and then buy it when you can afford it. Your home is the same way. Yes, it's a bigger purchase. This is where you don't want to just have a limited mind and start thinking bigger and understand the difference between investments that you buy for the purposes of making money and something like your home that you're buying for the purpose to make memories. Now, if you want my personal opinions, I do think that the Federal Reserve Bank is going to stay aggressive in raising interest rates. This raising in interest rates is going to cause mortgage prices to go up, and these rising mortgage prices are going to cause real estate prices to come down. Now the question is, how far down will they go? And that's going to ultimately depend on how aggressively the Federal Reserve Bank continues to raise interest rates, because at the end of the day, something's going to break, either the housing market or inflation. Remember, the Fed is working to raise interest rates to fight inflation, but if they keep raising interest rates and inflation doesn't fall, the housing market could break first. And so this is just a teeter-totter with who's going to break first. Is it the housing market or is it inflation? Because rising interest rates hurt both. Rising interest rates can bring inflation down, but it can also hurt the housing market, and this is the teeter-totter that the Federal Reserve Bank is watching. But right now, they have their eyes on inflation, and so if you want to gauge as to which direction the housing market is going, keep an eye on the Federal Reserve Bank, because if they stay aggressive on raising interest rates, you bet their home prices will fall down. But if they change their mind and then they say 6 months, 12 months, 18 months down the line that they want to start cutting interest rates and start stimulating, you bet that that's going to start boosting housing prices. So this is where you want to pay attention to what the Federal Reserve Bank is doing, not trying to time the market, but understanding the market. That way you can make smart financial decisions for yourself. And we cover all of this in Market Briefs for free. All success starts with your mindset, because now once you believe, if your mindset tells you that you're going to become successful no matter what, if you truly believe that you can do it, what are you going to do next? You're going to start reading books. You're going to start listening to audiobooks. You're going to start watching YouTube videos. And then you're going to start learning. Maybe then you go out and take a class, and maybe then you start trying things.